Hi, welcome everybody to this quarter's Weight of the Evidence recap. I'm glad to have you all logged on today. We've got a big group, so it should be a great call today. Just a couple of things before we get started with the presentations. Number one, I think there's a lot of stuff on the screen, but you can make the presentation bigger if it's a little small on your screen. So you can kind of play around with that and make the slides actually bigger if they're too small for you right now. Also, this call is eligible for CE credits. If you're listening to the call live, we'll process those probably by Monday and get those CE credits to you. If you're listening to the replay, there'll be a quiz at the end that you need to take in order to get those CE credits. If for any reason you don't get them or something happens, just let us know at Dorsey Wright and we'll track that down for you. So, as I said, we have a great call today. What we want to do is what we did the last couple times we've done these Weight of the Evidence calls. So we want to take a look at markets from three different angles. So we're going to look at the technicals, the fundamentals, and also the overall economy. I think this should give everyone a real good picture about what's happening. The markets have been crazy. There's been a lot of news, a lot of things going on, but we're going to try to cut through all of that and get to what's really driving the market right now. So on the panel today, we have myself. My name's John Lewis. I'm a portfolio manager at Dorsey Wright. We have Miles Clark, who is one of our analysts in the Richmond office. So if you read the daily equity report, Miles is writing for that, or you call in, you might get Miles help you out, that sort of thing. And then for the economic portion, we have Phil Mackintosh, who is going to go over a bunch of slides about the overall economy and where things stand. And then Yanni, who is the head of investment insights for capital access platforms at Nasdaq, will go over things from a fundamental standpoint. So for our part today and for what Miles and I will be going over, we really want to hit the major themes that we see right now in global markets. So one, that's going to be domestic equities. Where are we right now? What is the state of momentum? As you know, Dorsey Wright, what we do is relative strength and momentum. We've got a pretty good grasp on that. So we'll go over what we're seeing there. And then we'll also talk about some notable leadership trends. We'll go over international equities and other asset classes, commodities, things like that. So should be pretty comprehensive. Now, for those of you who are on the call that don't know a lot about Dorsey Wright, let me just give you a little overview about who Dorsey Wright is and what we do. We have three main parts of our business. So we have the research arm, and I mentioned the daily equity report. We put out a big research report every day. We've got commentary on all sorts of stocks, leadership trends, asset classes, that sort of thing. And we also have a bunch of models if you're interested in doing kind of rep as PM work and things like that. So if you go to DorseyWright.com, that's our research site, and there's a number of different tools available to you. There's some free things, or there's some subscription tools as well. Dorsey Wright is also known for making indexes that get licensed out to exchange-traded funds. And then we also have an asset management arm where we do discretionary investment management through SMA and UMA platforms. Now, the one thing that really kind of ties all of this together is our focus on relative strength and momentum. And I'll use those terms interchangeably throughout my portion of the call. But what we're really looking at is finding strong assets and trying to hold those until they become weak. It's pretty simple in theory, but sometimes it gets a little bit complicated. And you'll see, when we talk about what's strong in these strong assets, you can see on this performance quilt here, the dominant trend over the last 10 years that we're showing here has really been equities have been very good, large cap has been very good, and growth stocks have been very good. We've seen, some breaks in that, but we've kind of gone back to that theme repeatedly over the last 10 years. it's been a very long run where we've had this kind of leadership trend in place. Things like the Nasdaq 100 have shown incredible leadership. Growth, as I mentioned, has been a real leader, and the S&P has really put up very solid returns over the last 10 years, I think, as everybody knows. But in 2025, we saw a little bit of a shift there. So it's been a while since we've seen international equities at the top of this matrix. Emerging markets perform very well. Developed markets perform very well. A weaker U.S. dollar was really part of that story there. A weaker U.S. dollar makes foreign investing much more palatable for U.S. investors, really provides a tailwind there. And we really saw very good returns out of those areas, which we haven't seen in quite some time. Now, domestic equities were not far behind, at least the cap weighted and the large cap weighted area. We notched another year of 15+% performance. Growth definitely leading the way. Artificial intelligence train just continues to keep going. Now, we've seen some shifts under the surface with that and some different leadership trends kind of emerging at different times. But that has really been the dominant theme over the past year, year and a half, and that definitely continued throughout 2025. Small caps, they lag, equal weight lag, still put up positive returns, but nowhere near as good as these kind of large cap weighted indexes. And to get a little bit more into that, let me turn it over to Miles, who will just talk about where we are today with a lot of these indexes.
Perfect. Yeah, thank you, John. And first off, I want to say I appreciate everyone's time here this afternoon. I'm certainly looking forward to the presentation. We'll go ahead and start where, like John mentioned, a relative strength and technical research shop. So we'll start off the presentation with at least some commentary on the overall state of the market as we move into 2026. Now, I completely understand not everybody on the call is going to be a P&F expert here, so we'll do our best to keep it high level. In terms of our overall technical commentary. But what we're looking at here on the right side of the screen is going to be the default chart for the cap-weighted S&P 500. Now, we can kind of slice this into three different perspectives: a short, intermediate, and long-term perspective. So we currently trade at all-time highs in a column of X's. That's a positive short or near-term tailwind. Our international term, we trade on a pair of consecutive buy signals. Again, you don't need to be an expert to know that's a positive. And lastly, our long-term positive trend, we are well within a positive trend. Again, that's a long-term tailwind after a near test of that during our April tariff tantrum. And that's been a long outstanding trend back from early 2024. So again, that long-term trend line still intact here. And just a couple of points I think are worth mentioning in terms of relevant support levels. In the near term, if we do see some consolidation, there's plenty of support really littered in between this 2 to 5, 6% or so range away from current levels. So again, if we do see some type of near-term consolidation, that pullback certainly wouldn't be out of the question, and it would be what we would call normal from a technical perspective. And then just to provide further context, the long-term positive trend line I referenced before, just over 20% away. Now, certainly don't want to get anyone confused here. I don't hope that we get there in 2026, but again, just to kind of provide some additional context, that trend line is about 20% away. It's been ushering us higher for the better part of the last few years. Now, we can do the exact same kind of perspective, long, intermediate, and short-term perspective for the average S&P 500 stock. So most of us are particularly interested in how the cap-weighted S&P 500 is doing. But when we talk about breadth and the overall state of the market, we also want to take a look at how the equal-weighted S&P 500 is doing. So as John mentioned, that also lagged behind in Q4, but for the entire calendar year, was overall productive. And you'll notice we sit in a column of X's on a buy signal and in a positive trend as well. Now, just to highlight a couple of support levels, near-term support roughly 6% away from current levels, and that longer-term positive trend line around 10% away from current levels. So all things considered, a little bit closer for our equal or average S&P 500 stock in terms of that near-term trend line. That's largely due in part to the magnitude of upside participation for that group being a bit less intense in 2025. But I want to take a step away from the technicals for just a moment and talk about some seasonality that we have in play. As we kind of zoom out, we're in the seasonally strong part of the year. So there's 6 months that are seasonally strong, starting in September and ending around April. But we can zoom into January a little bit closer to take a look at what we call the January barometer. Some of you might be interested or have heard of the January barometer before. Some of you might not have. Regardless, the definition's up on screen here. It's this idea that the market is potentially positively or negatively influenced by how January performs. So if the first month is positive, the calendar year typically follows through. If the first month is negative, we typically see a negative year. Now, remember, this is purely seasonality, right? So there's a lot more in play than pure seasonality here, but some general statistics worth talking about. That table on the right, the January barometer since 1950 for the S&P 500, there's been 46 positive Januaries, 30 negative Januaries. And in terms of our overall hit rate, that first bullet over on the left, around 74% of the time we see follow through. So just about 3 out of every 4 times, not bad for a seasonal statistic, if I'll throw it out there. Next, in terms of our kind of positive hit rate, we're more predictive, if you will, during positive Januaries than we are negative Januaries. So when the S&P 500 is positive in January, we've gone on with seasonal follow-through to finish out that year up about 90% of the time. Less convincing when we actually turn on a dime, post a negative January here, only finish the year down around 50% of the time, which makes sense, right? Markets tend to go up. But again, keep this in mind. We're in a seasonally strong part of the year. The S&P 500 is positive, at least so far in January, which is another kind of feather in the cap for major markets as we move through the start of 2026. Now, I want to provide some additional clarity on just how strong major markets have been, not only for the last couple of years, but really for the last decade. And so here, this table is simply a count of consecutive 15% annual gains for the S&P 500, going back to 1929. Now, I know there's some projections in there before kind of the 1950s, 1960s or so, but regardless, since 1929, there's only been 3 instances in which the S&P 500 has gained 15% or more for more than 3 consecutive years, 3 or more years. Now, those points, again, you'll look at the late 90s, from the late 90s before kind of that lost decade there, as well as 2019 to 2021, and then from 2023 to 2025. So again, we're certainly in rare air, and that ultimately begs the question, or kind of leads itself to the next point. The last decade has been extremely kind to overall domestic equities. When you zoom out to the last decade, 2015 to 2025, that cumulative return nearly 230%. So that's a roughly 90th percentile rolling 10-year spread. So all said, kind of equal, or in more plain terms, your kind of core domestic market, your cap-weighted S&P 500 has been particularly strong over the last decade. And so that really begs the question, how much longer, right, can this persist, right? Whether you yourself are asking that, or maybe you've got clients calling in and wondering, when is the Mike Tyson uppercut going to come here? You'll see these instances. The streak was broke in 2000 with a 10% decline in 2000 and a 20% decline in 2022. But what momentum has taught us is that ultimately these performance trends can last a little bit longer than you might expect. You can ultimately see performance go on positively or negatively a little bit longer than you typically might think at first glance. So to talk a little bit more about momentum, the state of trends around the globe, I'll invite John back on to talk about what we might see in 2026.
Thanks a lot, Miles. So momentum had a decent year last year, not as good as it was in 2024. We have MTUM here on this kind of the one slice of the quilt here. And remember, as we go through this, now remember, MTUM is just kind of a plain vanilla momentum type of fund. But the big thing that I want to point out here is that it is capitalization weighted. A lot of momentum strategies that you see out there are not. They're more equal weighted, factor weighted, whatever. But that cap weighting has been very important over the last couple years, not in momentum, but also everywhere else, right? So when we look at kind of cap weighted momentum, it did lag behind in Q4, but it had a decent year. That's not super common for momentum to have a lagging Q4. So it was a little bit different this year than we had seen in years past. But this does mark the second consecutive year of outperformance for momentum. Can this carry forward into 2026, right? Once we have a couple years of outperformance, does that automatically mean that, okay, the momentum trade's over, we need to go look for another factor that might perform? But that's really not the case at all. When you look historically at overall performance trends, when momentum has shown strong performance in the previous calendar year, it does tend to carry over into the beginning of the next year. So that kind of indicates that we'll probably have a decent Q1. The odds are in favor of that. That momentum should continue to do well, despite having a couple years of outperformance already. Now, I mentioned that momentum had not a great Q4. And when we look at momentum seasonality, Q4 is normally the best quarter for momentum. I think a lot of that is kind of tax driven here in the US. Momentum is going to buy and hold the leading stocks, right? These are the stocks that are up the most over the last year, give or take. Investors are not going to want to sell these stocks as you get close to year end. If you're going to sell them, you might as well wait for the calendar to flip and for those taxes to be pushed off another year. So generally speaking, I think that's a big reason why momentum does well in Q4. There's just a lot less selling pressure at the end of the year. Q1 is not horrible. January, there's a January effect. If you read some momentum literature, some places that do research will take January out and show you kind of the returns ex January. So there is kind of a lot of that extra selling pressure at the beginning of January. Again, we'll see if we get that this year and how deep it might be. It doesn't have to be the case, but that's kind of generally how things have gone over time. Now, when we look at momentum, especially on the domestic side, these are the returns from the performance quintiles for last year, 2025. That top momentum quintile, the top 20% of names, did better than the laggards or the bottom area. Now, that kind of the second to the last quintile actually did the best last year, but what we do like to see are those top momentum names as a basket outperforming the laggards. And all we're doing for these momentum indexes that we use for this, we just run a very simple 12-1 momentum model. We separate them out by quintile. We rebalance and equal weight them every month. Right. So it's just a very simple way to look at these strong stocks and how they're performing relative to other areas of the market. It was nice to see the leaders outperform the laggards over long periods of time, but 2025 was not without some major laggard rallies. We saw definitely starting in January with that DeepSeek announcement, also the tariffs in April. So those were two times there that momentum was really disproportionately affected, and the highest momentum names really took the brunt of the selling. Those were generally the AI trade names, so semiconductors, even down to the utility companies that were building out the infrastructure for all these data centers that are required for all this AI infrastructure. So hopefully we can see the spreads kind of continue to rise, see good momentum performance here on the domestic large cap side. On the international side, emerging did much better in 2025 than it had previous years in terms of overall momentum. emerging had been the spot where we weren't seeing the best momentum indicators. China had been an issue in terms of momentum, but that's really changed, and we really saw a pickup in that leader versus laggard relationship. Starting maybe in the spring. And momentum really started to perform much better. And as we showed earlier, just as a broad market benchmark, emerging markets wound up doing the best out of all those kind of broad equity asset classes that we're tracking. And finally, on the developed market side, this is really where we've seen a lot of the best momentum indicators for quite some time. So the spreads have been very good. They're indicating that the leaders continue to outperform the laggards in developed markets. You can see here the quintiles, just kind of how they stack down, with the best momentum areas doing the best and the laggards doing the worst. So this has been very good to see. International developed has been a great spot for momentum over the last couple years. Now, another way to look at international investing, you don't just have to look at individual stocks and momentum, but we also look at a lot of country rankings and things like that. So let me bring Miles back to talk about what we're seeing from a country standpoint on the international side.
Perfect. Yeah, thanks, John. I appreciate you talking about how great internationals have been. Domestic equities have spoiled us for the better part of the last decade. We haven't necessarily had to worry about what our international exposure looks like within our portfolio. So I'm sure for a lot of you on the call today, there's a lot of questions after such a productive 2025. Ultimately, what is 2026 going to look like, and how am I actually going to be allocated within my international exposure within my portfolio? So to answer that question, Dorsey Wright utilizes what we call a relative strength matrix. Now, in layman's terms, I want you to think about a matrix like a big arm wrestling contest. We can throw a bunch of representatives into this matrix and then ultimately focus on the top areas. Those are our strongest members. Those are the ones we want to kind of are fit for investment, and we want to avoid the bottom. Now, we can do this for individual stocks. We can do this for funds. We can do this to compare stocks to benchmark, which we do within our relative strength strategies that will run on the platform. But in this case, we can take a look at 41 different country representatives and then, again, throw them into the matrix and focus on the top half as points of relative strength. Now, here are those rankings on the right side of the page. Certainly thumb through them. I'll read the top 5: Israel, Hungary, Italy, Czech Republic, Greece. But what I think is more interesting than the individual names is actually looking at how the group is made up when we look at those top 20 individuals or in individual countries, and then overall what that ranking has changed or how the ranking has changed through Q4 so that we can stay ahead of the game as we move into the new calendar year. So we'll first start with the top half composition. And what we'll notice is our friends across the pond over in Europe, they're making up the majority of our total exposure within this top half of country representatives. So European representatives have earned their stripes over the last year and a half or so. They represent 13 of the total top 20, if you will. There's certainly points of relative strength elsewhere in the globe as you look at emerging Americas, the Asia Pacific space as well. But those are, less significant in terms of their long-term strength. But what you will notice when you drift down to the bottom table here, and how is that shifted over the course of Q4. Now, you look at, for instance, those points of long-term relative strength. You've seen some of your European representatives lose some of that long-term strength in terms of their overall movement, ceding that strength to the likes of emerging Americas, emerging Asia Pacific. So this is, at least for me, a point of significant interest as we move into 2026. Are we witnessing, or is it possible for international equities to see a peaceful changing of the guard, if you will, in terms of their kind of long-term relative strength picture? Now, I want to take another opportunity and talk specifically just again about the magnitude of international excellence that we've seen throughout 2025. And we can do that by looking at the overall calendar year performance spread for a representative like ACWX versus the cap-weighted S&P 500, and we can take that and display it over time. So here, looking at that excess performance spread since 1988 there, and what we saw in 2025 was a near 14% outperformance for our international representative. That's the widest margin in roughly 3 decades, right? You had a couple of instances there in the lost decade in the 2000s, but for the most part, this is the widest that we've seen since the early 90s. Now, really, there's kind of a big question of, well, are we entering another environment where international equities can put together strings of outperformance? Or are we kind of stuck in this period that we've been in since essentially the turn of 2010, where any international outperformance was really essentially gobbled up by domestic counterparts in the preceding years? So this is definitely something that we're going to be watching as we move into the new year. And what we'll actually be watching, or a catalyst that could send international equities higher, will be the decline or continued decline of the US dollar. Now, there's a lot on this chart here, so we'll do our best to define it. Dorsey Wright tracks whether the US dollar is rising or falling, depending, or tracked by a 10% rise or fall against a relative peak or trough. From that point, we can then take a look at different asset classes across the globe and measure average performance in rising or falling dollar environments. We've also, which we'll talk about more in just a moment, graphed via that yellow diamond current performance for each one of those asset classes. So the US dollar has been a falling dollar since January of 2025, so just about a year or so at that point. And what you've seen is largely as you would expect, right? The domestic equity part, as we look towards the middle of the graph, largely agnostic whether we're in a rising or falling dollar environment. International equities tend to do particularly well when the US dollar falls, and they have done as such during this current environment. And conversely, commodities also tend to do typically well when the US dollar falls. And that's what we want to focus on as we kind of move through this technical picture. Gold is directionally in line. Gold and other precious metals are directionally in line with their long-term historical averages, right? They are appreciating, but they're well above average. So this is something that we're watching on the commodities front. And then the last point here on this dollar table will be crude oil, which is the fourth line over there, which is typically extremely positive during falling dollar environments, but has not been as such in 2025, entering 2026. So we could see continued volatility here, especially if we look at mean reversion, continued unrest around Central and South America with Venezuela. That'll be something that we're continuing to watch. And then we'll wrap up here briefly with just some brief commentary on the fixed income space. That is a general point of weakness in terms of our broader asset classes. Fixed income remains a point of relative laggardship, if you will. But when you look at the overall points of strength within the asset class, which is depicted over on the left side of the screen, you'll see similar themes to what we've seen in the equity group, which is risk on is really taking the way. So equity-focused convertibles are towards the top. International options are also strong as we move into the new year. Conversely, those points of relative weakness, broader fixed income, as I mentioned before, remains acceptable at best, as well as U.S. Treasuries and points further out on the curve. Longer duration assets have remained relatively weak. With that said, John, I'll invite you back up to have the last word from the technical front, and then we can pass it on.
Great, thanks, Miles. So just from a technical standpoint, where we want you allocated, heading into 2026, overweight domestic equities, especially large cap, and on the growth end of the spectrum, Nasdaq 100, that sort of thing. That's really where the leadership continues to be. International equities are also a place that we would like you to focus. You need to be or have a decent weight there. Commodities sit in the middle of the matrix. Again, when something's in the middle of that matrix, you have to be a little bit careful. You don't just go whole hog in there. I think you really want to pick and choose what you're buying, especially out of that commodity area. The precious metals area and industrial metals area are a much better place to be than some of the other areas. Gold and silver were really standout performers throughout the year and especially in Q4. There's a lot of volatility there, but there's also a lot of return there as well. And then fixed income remains a laggard and underweight area. We realize that a lot of people have to have that in the portfolio, but we'd like to see that down on kind of the lower end of where you can be for your client accounts. So that kind of covers things from a technical standpoint. To go over the economic outlook, let me bring Phil on, and he's got some great information to share with you all.
All right, thanks, John. So let's get into some of the charts and thinking forward, like obviously it's a good time to think about 2026, but let's start by looking back at how economies performed last year. So looking at this chart, we see all the gray dots. That's the GDP growth for all the different countries that we show in this map. And basically everybody avoided recession. The bars show the expectations for economic growth in 2026. And you can see once again, relatively slow growth is expected, but positive growth. So the word recession seems to have disappeared from a lot of the media and a lot of the commentary at the moment. The Nordics, which is the gold colors, have done really quite well as an equity grouping, and obviously emerging markets as well on the very far left. So that's really where the performance in the economies has come from and is expected to keep coming from in 2026. I see three main tailwinds that are going to be positive for the economy, but also for stocks. And that's basically the fact that we have lower interest rates now, the fact that we still have spending and jobs are holding up, and then also obviously the AI boost, which is probably still going to go on in 2026. So let's look at some of the data for each of them. What this chart here shows is the central bank movements in rates. And the cutting of rates has been going on for a good couple of years now. You can see Europe and Canada have got to the point now pretty close to 2% where the market's basically expecting no more cuts, maybe an increase, but actually no more cuts. So we have low rates for companies. That's going to be a good thing for interest expense going forward. It should be reasonable for the housing market. The US, which is the blue line, we waited out tariffs to see what they would do to inflation. They really didn't do anything. And so now we're back into cut mode. The Fed is kind of talking tough, but the futures market has us seeing 2, maybe 3 more cuts through the end of next year, or this year now, getting us to about a 3% rate, which is obviously about half of where we were at the peak. So interest rates are already low in a lot of places, heading lower in the UK and the US. And I don't really see a lot of reason for rates to not keep falling. If we look at this chart here, this is inflation around the world. And you can see that inflation has basically, it obviously increased a lot to that sort of 8-10% rate. It's been down back pretty close to 2% now for a while. And if we look at some of the other indicators, wages are relatively soft because the labor market's relatively soft. A lot of the supply chain problems that we had have come out of the market. As Miles mentioned, oil's been pretty weak. So there's not a lot of potential upside risk in the immediate, like barring some kind of geopolitical risk. So the outlook for inflation and rates really is pretty good and pretty constructive. This is showing around the world the sort of the jobs market. The fact that there is a negative on this chart doesn't mean that jobs are falling. It just means relative to that period before COVID, the growth in the jobs market is weaker now. But it's not like tariffs caused the job market to crater. It's not like anything specific has made the jobs market suddenly worse. You can see the jobs market, having been really hot coming out of COVID, has just been coming back down to much more normal and balanced levels. And that's taken a lot of pressure off wages, which has taken a lot of pressure off the expenses and margins for companies. The other thing that's going to be really helpful and constructive, especially for small cap companies, is the lower interest rates. So when you look at what happened in the last couple of years, obviously when the Fed put rates up, for small cap, the interest expense went up quite a lot. It was at some point at the top there chewing into almost half of their EBIT was going out in interest expense. Now that's started to turn. So the lower rates are starting to feed through into the costs of debt capital for small cap, much less so for large cap. Large cap looked like they were able to lock in much more long-term fixed financing. But the smaller the companies, probably the more you're going to see benefit from these low rates going forward. So the second tailwind is the fact that even though jobs I just showed you are not looking super strong, they're holding up. And so that's helping spending holding up as well. What's interesting looking at things like wages is if you look at the average, and the middle here is pretty close to the average, the middle income group, we've actually seen wages growing at around about the same amount as inflation. So the wage growth's been there to help support spending. What's been starting to happen, though, you might hear about a K-shaped recovery. The higher income bracket people are definitely benefiting in more than the lower income. So this is looking at wages. Coming out of COVID, low income people saw wage growth. High income people really fell behind. That's starting to now correct. If we look at a really similar chart for spending, it's basically showing the same thing. Higher income really are holding up the average spending coming through the system. Lower income, it looks like they're starting to budget more, put more money on credit cards, run some delinquencies as well. And if we look at some of the fiscal stimulus that's going to come through this year, Germany has already increased its debt limit. So some of the European countries are likely to see a little bit more constructive fiscal spending. In the US, we obviously have the One Big Beautiful Bill Act. It is going to add, by a lot of estimates, about 1% to GDP, and also, coincidentally, about 1% to consumption spending as well. When you look at the distribution across income brackets, which the right-hand side of this chart shows, higher income people are going to benefit much more. In fact, some of the lowest income people will probably find that the tariffs and some of the other tax changes don't actually help them at all, and maybe make it even worse for them. So again, that K-shape might get even more exaggerated. But net, quite a lot of money in the high income brackets, which do most of the spending in the US economy. And so if we kind of put that all together from a company's perspective, if you've got less wage inflation, lower interest costs, a better balanced labor market, suddenly you can start to focus on growing your sales, controlling your margins, and increasing profits. And that's what the market's expecting. So the skinny bars in this chart show for each region the earnings growth that we saw last year. The fatter bars show the earnings growth we're expecting in 2026. And so you can see the Nasdaq 100, which was the leader, it's still got pretty decent earnings growth expected, but it's actually going to be slowing down from what happened last year. The 2000, the small cap space in the US, is definitely going to start to see some flow through, which is positive. But around the world, like the guys have talked about, the broadening out of good performance across the world. I mean, Asia and emerging markets and in Europe, you're starting to see as everybody starts to benefit from things being a bit more normal. So let's talk a little bit about the AI boost. Everyone's starting to worry whether we're in a bubble, and I guess that's what you start to worry about when you see the top 10 companies being 40% of the S&P 500. Their prices have gone up a lot. Their market caps are, in some cases, very huge. NVIDIA, I saw a chart the other day, is bigger than the whole Japanese market now. But what's interesting is the prices went up in anticipation of revenue growth, and this year we've actually started to see that revenue growth. So the revenue in those top 10 companies is pretty concentrated compared to the whole market as well. When you look at what's driving the revenues, it is a lot of this AI story. It's CapEx, it's chip sales, it's data center build out and rentals. The expectation is we're going to see almost $500 billion invested in total last year and basically again this year. And so that's a lot of money to invest in the AI complex, but it's also real income for the companies that are selling product into the complex. And so what's actually happening for, in this case, we're looking at the top 5 stocks here, are the NVIDIA, Microsoft, Apple, Google, and Amazon group. Their price earnings multiples, because their earnings are now growing faster than their prices, are starting to come down. So really different to the tech bubble where we had a whole lot of companies IPO with relatively low earnings. They burned through cash. They didn't have customers. And eventually we had the bubble burst. This time, the companies that are actually doing the AI spend are spending some of their profit, basically about 40 to 50% of their free cash flow. Their profits are growing now, and their price earnings multiples are actually coming down. So relatively constructive on the listed company front. And interestingly for me as an economist, the amount of money being spent is also starting to boost the economy. So that red circle there, you can see the positive GDP that we've been getting quarter on quarter. A decent chunk of that is coming from the spending that's happening in the space in the US. I think what's interesting is that the trade so far, if I think back to the tech bubble when I was managing money myself, you had the tech stocks rally first, and then you eventually had the media and the telecom space start to rally as people started to look broader into who will benefit from this trade. So I think what we've seen so far is the infrastructure space has definitely rallied, but we haven't seen any rally in companies that might grow product out of AI. We definitely haven't seen any real response yet in terms of companies that are able to use AI to become more productive and increase margins. So it's possible there's quite a lot of, I guess, economic benefits to come from AI, and even on the market, like a pivot away from just pure building out data centers and renting them to actually deploying into products, building products, and making yourself more efficient and making companies more profitable. In terms of the sort of economic cost benefit, what is expected is that AI will create a super productivity boom. And so when we look back at the internet was obviously built in the 90s. What you saw in the sort of early noughties, though, was about 10 years of a really above average level of productivity improvement. If we just do the math on that and we have AI replicate that, it was about a 1% improvement or more in productivity over 10 years. That's 10%. The US economy, if you look at that green text in the top right, is a $30 trillion economy. So from an economic benefit perspective, you could easily see a productivity gain adding $3 trillion to the economy. So $500 billion a year of investment could easily be worth it. Picking the winners and losers is going to be important for investors, I think, as things play out, especially when we look at how the tech bubble worked. So there's one more tailwind I want to hit on before I hand over to Yanni, and that's just because I work in a stock market. It looks like investor appetite has definitely improved. These two charts here are showing day one performance of companies that are IPOing. So we've had a pretty decent year of IPOs in the Nordics and in the US, with both of the markets Nasdaq runs. What's interesting is a lot of the outperformance you actually see from the overnight book build price to the open, and then most of the market trading in the follow through to the end of the close. And that's what we're looking at, is from the overnight book build to the end of the first day of trading. And so we've had 34% average returns. There's obviously some companies that have gone down on their IPO day, some that have gone up a lot more than 34%. But 34%, if we exclude that 2020 COVID period, is the high for this decade plus in the window. And kind of a similar result for the Europeans. There's only one period that was really a lot stronger, and that was 2022, so coming out of COVID in the Nordics. But to me, the fact that investors are getting into IPO stocks is constructive just from a risk-on perspective, which Miles mentioned as well. And with that, I will hand over to Yanni. I think you might need to unmute, Yanni.
All right, it seems like Yanni's having a little bit of difficulty with his microphone. So while he gets that sorted out, we had some questions come in, and I thought one was interesting. Phil, if maybe you could take this one. Someone asked, when you talk about lower rates benefiting small cap stocks, the question was really like, is that on the short end of the curve, like Fed funds rate, or do you really need to see like intermediate term rates and longer term rates come down as well to benefit those smaller cap companies?
So I think the answer to that is yes for both. So I guess if both happened, it'd supercharge the impact. A lot of small companies have not been able to finance out 10 years just because they have higher credit risk. So even their fixed rate debt seems to be shorter duration, but they also have a much higher proportion of just floating rate debt. So the fact that the short term, like the front end of the curve is coming down, is going to benefit small cap quite a lot. About a third of their debt is literally floating, and about another half of what's left is relatively short dated. So will need to be rolled pretty quickly. So that's one reason why they benefit so much more quickly than a lot of the large caps, especially because rates got so low during COVID. A little bit like households in America, the larger companies were able to go out and lock in 10-year plus financing. That's got a little bit of a wall of maturity in a couple more years. But as we're seeing, like rates keep coming down, they might not even stress companies out to refinance that really low fixed rate debt. But we might start to see, I guess, large cap financing costs going up a little bit when they start to refinance their long-term debt. And the small cap companies have much shorter windows of duration to have to refinance.
Can you guys? Okay. Yeah, Yanni, we can hear you now. So thanks for answering that question, Phil. And Yanni, we'll turn it over to you now that we seem to have those hiccups solved.
Great. Well, hopefully you guys can hear me okay. Really apologize about that. So I'll have to run through. Great, thank you. So starting off on slide 55, I think it's important to take a step back, right, and to look at history. And at the end of the day, we come into any given year averaging an intra-year drop of about 14%, right? So the headlines were filled with risk last year, but at the end of the day, it was earnings-dominated performance, which I'll get to in a second. And here we're just showing that 76% of the time since 1980, right, U.S. equities have ended up finishing higher. Now, taking a step back again, more zeroing in on 2025, as the other guys ran through, it was really an all-everything rally, if you will, right? Of course, U.S. equities, as was mentioned, the third straight year of double-digit gains. Gold, the best annual year since '79, given some of the reasons listed on there as key drivers. And also those drivers inversely negatively impact the dollar, which had its weakest return since 2017. The weaker dollar, of course, propelled EM equities to their best year since 2017. And international and European equities had their strongest year since 2009. So net, right, as we've covered again, strong year across asset classes, across equities geographically, and across equities from a style perspective as well, too. Now, just to stick on the theme with international, right, a couple of key drivers and key tenets I think that are worth mentioning. One of them is the relative valuation discount versus U.S. equities. And on the left-hand chart here, we're simply showing the next 12 months PE, and on the right-hand scale, showing versus the 10-year averages, right, across equity markets globally. And of course, as we can see, international equities lower than U.S. equities, which we all know and has been a key driver as well. Now, on U.S. equities, what I think is interesting, and Phil had shown this as well too, but if we're zeroing into the premium of U.S. equities versus the 10-year average on July 1st, and then where we are currently, you can see that there has been that equity valuation compression, right? And why is that? It's because earnings growth has been so strong, which I'll get to in a bit. So you've seen this. Yes, we are elevated in terms of valuations, but you have seen very strong earnings growth given the resilient economy, right? Given the AI theme, which continues to be a tailwind, even though we have elevated valuations. Also, the weaker dollar, right? Miles had touched on this as well, but at the end of the day, a weaker dollar is synonymous with accommodative financial conditions, right? And in blue there, you simply see the Dixie, and this is on an inverted basis on the right-hand scale. So up is down and vice versa. And you have U.S. equities performing well and also international equities, but particularly EM equities. So highlighting two of the key drivers for international equities, which I think can continue to play out as we go forward. Now, it's not going to be a fundamental presentation here without a little bit of the great valuation debate, as I'm calling it here. And these are a couple of charts from our index research team, and I think the link to the report has been dropped into the portal here. But if we look at what profitability looked like for the Nasdaq 100 in the fourth quarter of 1999, right? We're looking at it measured here as full year net margin, right, as a percentage. And you can see that there are around 21 unprofitable Nasdaq 100 companies in the late 90s. And we're also plotting it here in terms of earnings to yield, right? So taking the inverse of PE. So up is actually cheaper. And you can see the smattering of purple dots here where things were more expensive during the dot-com era, right? Not saying that things are cheap here, for where we are now, but if we're comparing this in terms of profitability and then also in terms of valuations, right, it really is a different type of story when you're looking at these two kind of fundamental metrics. And on the right-hand side, we see this bucketed across different valuation avenues here, right? And the overwhelming majority of the current valuations for the Nasdaq 100 are in those first two buckets, whereas over almost 2/3 were 60 times and above. And then you had 10% of the Nasdaq 100 market cap weight, right, being unprofitable onto itself. So just want to highlight some key differences here between then and now. And look, when it comes down to valuations, right, elevated valuations certainly make markets more susceptible given the very strong returns we've seen and as investors continue to question the repeatability and, of course, the concentration in the mega cap tech space. But I think it's more important to focus on fundamentals versus trying to time the markets based solely on valuations, because at the end of the day, this is not a good predictor, right? And as an example here, looking at the S&P 500 next 12 months PE and subsequent 1 year and 5 year returns, right? There's really not a strong relationship here. So you have to have more of a thesis, and it can't just be driven by valuations in terms of why someone is being bearish on a 1 and 5 year basis. Now, I think a key story here is really the search for a possible rotation or an expansion of leadership and a broadening of opportunities. And net, we remain positive on a 6 to 12 month view, given the underlying fundamentals, which Phil had run through, but I'll just note on them again: a resilient economy, strong earnings growth driven by the AI theme, and fiscal stimulus and Fed easing. Of course, the fundamental risks, geopolitical volatility, AI capex concerns, and the valuation story, right, to some degree. And given the tech concentration in the US, you can't be bullish and not be positive at tech and on tech at the end of the day. But that doesn't mean that you can't have a broadening in participation or leadership, right? There may be some tech AI fatigue and vulnerability given the elevated valuations, but fundamentals remain very strong. And the left-hand side, just in terms of the price action in blue, we're showing the 2025 returns, right? And very orderly as to be expected, as we've run through already. But look at the returns since the prior high on October 28th. And granted, this is a very short time frame, right? So take it with a grain of salt, as we've had these head fakes before, but I'll get to why I think the fundamentals are supportive here. You have things like large cap value and S&P 493, the remaining ex-Mag 7 performing well. And drilling down a bit deeper in terms of the sectors, right? Again, we know what happened in 2025 in terms of the leaders. But interestingly, you're having financials, you're having healthcare, materials, energy outperforming over the past few months, right? And I think this is speaking to more investors looking more into the value cyclical areas underpinned by what has been a more resilient economy as well. And in terms of the fundamentals, at the end of the day, it would be really about the earnings growth projections, right, and expected EPS growth. And of course, tech, right, remains very, very strong if we're looking at the 2025 EPS on a year-over-year basis in black. And then in blue there, you're seeing the expected growth still in tech as well. But I think more importantly, in terms of talking about this diversification and broadening and potential returns, right, materials, industrials, consumer discretionary, again, more cyclical, value-oriented areas, they're expected to have very strong EPS growth in 2026 versus 2025. And if you're looking at the broader U.S. markets, right, Russell 3000 is an example. The median stock earnings growth there is at its highest in almost 4 years. And going down a bit deeper, reflecting what Phil had mentioned in terms of small cap profitability, right? the median Russell 2000 earnings growth is set to be the highest in 4 years as well. Now, the one thing I want to caution here in terms of earnings out of the small cap space, right, certainly being buoyed by the lower interest rate environment as the Fed cuts rates, as 40% of small cap debt is floating rate debt versus 10% of the S&P 500. But look what's happened here on the right-hand side, right? It's really been a junkier rally in the small cap space. So I think something investors need to watch. As since the end of August 2025 and Powell's Jackson Hole speech, you've really seen this delta, this wedge formulate between the unprofitable small cap names and the more profitable small cap names. So just having to do your homework on that one. And then finally finishing off as I call it, a Fed divergence, right? And I'm not just talking about the FOMC board and members calling for higher or lower rates. There's a strong relationship and things we continue to need to be aware of in terms of the moves in 10-year yields, right? And over the past year or so, year plus, right, since September 2024, if we're using that as the Fed rate cutting cycle beginning, this is the first time since 1998 you've actually had 10-year yields rising, right, despite the Fed cutting rates. And this is a reminder for investors in the markets that the longer end of the yield curve is more at the behest of the markets, right, in terms of economic and inflation expectations, in terms of fiscal deficits, debt to GDP, right, and the term premium there as well. And I mentioned the 10-year relationship with equities because on the right-hand side, if we're looking at the historical correlation of monthly global equity returns broken out by region and by sector, and then Treasury 10-year yields, right, you can see that it really focuses in those more cyclical areas again and more in the international space. So as Phil showed, if we're not having the recession word happening now, right, and 10-year yields kind of remain in this range and it's more of a cyclical led rally, right, then these could be interesting opportunities for investors from a fundamental perspective. And then finally, taking a step back, right, again, and looking at what the rolling 3-year returns looks like, just another angle in terms of what the Dorsey Wright guys had shown. But if we're looking at 3-year returns, right, for Nasdaq 100 in black, if you take out the snapback period in COVID, take out the snapback period in the GFC, you have to go back to the early 90s for such strong returns. And you can see the large deltas versus the international markets. So certainly room for catch up here, particularly as U.S. equities have a strong concentration of around 65% in MSCI ACWI. Again, you don't need large cap tech in the US really to fall in order to get more participation. But I think for investors, the story will be looking for those international opportunities for incremental new dollars coming into play. So with John, I'll turn it back to you. And again, apologies for the audio issues on my end.
Great. Thanks a lot, Yanni. Great information. And thanks to all the panelists who took time to put the slides together. We have a couple minutes until the call is scheduled to end. I know we've had a lot of questions about getting the slides. There is a related content area on the On24 platform. You should be able to go in and get those slides there. Also, we'll have a replay of the call. We'll send that link out to everyone over the next couple days. So watch for that in your inbox. As I mentioned, we did get a lot of questions. So one thing somebody asked was, we talked about the leaders doing better than the laggards in 2025 and kind of what areas are we looking at for emerging strength. I think right now, when we look at that, in terms of where the highest momentum names are on the domestic large cap side, the biggest increase that we've seen over the last couple months is in the healthcare area. A lot of biotech names, things like that. So that's something, healthcare hasn't been a huge weight in those high momentum indexes for a while, but we've definitely seen a lot more weight come in over the last 6 to 8 weeks or so. Now, also, if I could bring Miles on for a second, we did have a question about the Dolly rankings and, kind of what those are. And could you just kind of briefly talk about how those are calculated and kind of how investors should use those?
Sure. Yeah. First off, again, thank you for everyone for joining this afternoon. The Dolly rankings are essentially, we talked about during my section, a big matrix. And so what we'll do, we looked at in the slides today, we looked at a matrix of country rankings. What the Dolly rankings are, a dynamic asset level investing tool, takes representatives from 6 different asset classes: domestic equities, international equities, commodities, fixed income, cash, and currencies. And from there, we'll essentially throw those representatives into a big matrix. And like I mentioned before, run that arm wrestling contest between all of those representatives. From there, it's as simple as just looking and counting up the number of wins each representative has, and then ultimately ranking those broader asset level investing or broader groups from top to bottom. So we can do that from again, that broad perspective, the broad assets. We can then do that exact same process within each asset. So the most popular one is within domestic equities. We can go do that from a sector perspective as well. So we can see, hey, what sectors are doing particularly well as we move into the new year. So it's a very popular page on the platform, and it's all based in that matrix tool we talked about.
Oh, great. Thanks a lot, Miles. So we are at the top of the hour here. I want to thank everybody for logging on and listening to the information that we had for you today. I know there's been some chatter about the slides, and it appears it might be appearing for some people and not for others. We'll see what we can do about getting those out to you when we send out the replay link. So kind of look for that. We'll try to do anything we can to get those out to you. So with that, I want to thank everybody for taking the time today. We'll do this again next quarter. We'd love to get any feedback from you so we can make this call better as we go through time. So thanks, everybody. Have a great rest of your day.